Mobility Global, ticker MBGL, they just reported Q2 2026 earnings, and we are looking at a massive bottom line miss right out of the gate. I mean, the consensus expectation for earnings per share was 46 cents, but their actual GAAP diluted EPS came in at just 18 cents.
No, that is a huge miss.
Right. And on the top line, actual revenue hit $468 million, which is, it's a 7% year-over-year increase, but it's still a miss compared to the consensus expectation of $472.4 million.
Yeah.
And it completely missed management's own internal expectations, too.
Which is why we saw the guidance cut.
Exactly. They just cut their full year 2026 revenue guidance to a range between $1.87 and $1.88 billion. So they're bringing that expected growth rate down to like the 6.9 to 7.7% range.
And, the market reacted exactly how you would expect to a shock like that. We saw the stock dip about 0.92% in the pre-market, and then the bleeding just continued. By the time the closing bell rang, shares were down nearly 5%, landing at around $19.70 a share.
So today, we are taking a deep dive into Mobility Global's earnings report, the management commentary, and the latest analyst notes. Because we really need to figure out if this disastrous first quarter as an independent company is just a temporary stumble or a slashing warning sign of deeper structural cracks. Because stepping out of the S&P Global shadow with a 60% EPS miss, that is not the narrative you want to hand to retail investors.
No, it's definitely a rough debut, but I think there's a reason investors aren't outright panicking and sending the stock down like 20%. To understand the actual underlying stability here, we really have to look under the hood of that $468 million top-line figure. The headline miss grabs your attention, obviously, but the revenue composition tells a much more nuanced story.
Right, about your downside protection.
Exactly.
Because the foundation of Mobility Global is highly recurring, which is what you want when macro conditions get choppy. Out of that $468 million, total subscription revenue accounted for $383 million.
Which is up 7%.
Right. It proves they have this durable base of customers who are locked in, paying regularly, totally, regardless of month-to-month volatility in the broader auto market.
And when you break down that recurring revenue by the actual business units, the Carfax X segment is doing the heavy lifting. I mean, Carfax alone brought in $312 million, which is up 8%. Then you have the B2B segment.
That's the one that houses automotive masterminds, right?
Yes, exactly. That brought in $156 million, up 4%. And even the non-subscription side, the transactional revenue where they get paid per report pulled.
Right.
That actually managed to hit $85 million, up 5%. So we are looking at a scenario where literally every single segment of the business is growing. The problem is just that the growth is slightly slower than Wall Street wanted.
Which brings us to this really crucial divergence in the profitability metrics. And I think this is something you really need to understand to make sense of this quarter, because it completely recontextualizes that massive EPS miss we hit you with at the top of the show. It's essentially a tale of two different profit metrics going in completely opposite directions.
It really is. I mean, you look at their GAAP net income, and it dropped a staggering 18% down to $53 million.
Ouch.
Right. If you stop reading the earnings report right there, it looks like the underlying business is deteriorating fast. But if you look at adjusted EBITDA, it actually climbed 7% to $202 million. And they even managed to expand their adjusted EBITDA margin by 40 basis points, bringing it up to 43.2%.
And the Carfax segment alone is operating at an insanely lucrative 49% margin.
Yeah, it's a cash machine. They've maintained a gross profit margin of over 70% over the trailing 12 months. So the core profitability of their daily operations is expanding. It's not like the cost to deliver their software suddenly skyrocketed.
So the gulf between those two profit metrics, GAAP net income, plunging while EBITDA climbs, it all comes down to the mechanics of their recent spinoff from S&P Global. Think about it like looking at a household's finances. Your GAAP net income is essentially your take-home pay for the month after you just got hit with a massive one-time medical bill.
Right. And in this case, that medical bill is the massive pile of one-time separation costs associated with, legally and operationally breaking away from S&P Global. It hurts. The bank account looks lower this quarter, and the bottom line just takes a beating.
But your EBITDA represents your normal, healthy monthly budget before that freak expense hit. The underlying earning power of the company's core software business is actually stronger than ever. The take-home pay will eventually recover once that medical bill is paid off.
Exactly.
And here is the really interesting part. This underlying operational strength actually highlights the real puzzle of this earnings report.
The top line.
Yes. If Carfax is such an absolute powerhouse, pumping out $312 million at a 49% margin, why on earth did the top-line revenue fall short of expectations? If the product is that good and the margins are that high, where's the friction coming from?
Well, analysts were hammering management on that exact point during the earnings call, and CEO Bill Eager gave a surprisingly candid answer. It comes down to a very specific, totally self-inflicted strategy error.
Oh, wow.
Yeah. Late last year, Mobility Global decided to fundamentally change their go-to-market approach for Carfax. They shifted away from letting dealerships buy individual products a la carte and instead moved toward a bundled sales strategy.
The classic corporate upsell maneuver. You package all your software together into one massive premium suite, hoping to, drive higher overall adoption and just juice the average revenue per user. But bundling completely changes the psychology of the pitch.
Totally. And Eager admitted it completely backfired. Yeah, by pushing the bundle, they stretched out the sales cycles significantly and actively hurt their own adoption rates. Just think about the conversation the sales rep has to have now. You're no longer calling a dealership manager and asking them to sign off on a single, targeted $500 tool they need right now.
Right, you're hitting them with a massive bundled price tag.
Exactly. You're forcing that manager to pause and reevaluate their entire data software budget for the whole year.
You are introducing so much unnecessary friction. A manager can approve a small monthly subscription out of discretionary funds without even blinking. But if you ask them for a massive bundled contract, suddenly it has to go up the chain for approval. It's competing with every other expense on the dealership's profit and loss statement.
And management is acknowledging that misstep now. They are currently executing a major go-to-market reset, basically pivoting the sales teams back to selling individual products. The new philosophy is let dealers buy what they need today and then slowly build them up to the full software package over time.
I am going to push back on management's narrative here, though.
Okay, let's hear it.
Because we have to ask if the failure of the bundled sales approach is just a convenient excuse for a top-line miss. Like, is this really just a sales tactic problem, or could this be a sign of structural weakness in dealer demand? Dealership margins are notoriously tight right now. Maybe they just don't want to pay for premium software bundles anymore.
It's a completely valid area for skepticism. If you look at the broader auto retail landscape, dealerships are facing significantly higher interest rates on their floor plan financing.
Right, the debt they use to buy the cars sitting on their lots.
Exactly. And at the same time, consumer demand is shifting as buyers feel the pinch of inflation. So if you're a dealership operator looking to aggressively cut costs, premium data bundles from third-party vendors, that's an incredibly easy target to cut.
But management is insisting that the underlying demand for the individual tools remains robust. If the dealership needs the data, they'll pay for it. They just won't pay for all the fluff packaged around it.
Which is exactly why Mobility Global is rushing to launch a whole new suite of highly targeted individual products right now. They need to prove the demand is still there by rolling out tools that dealerships feel they literally can't live without.
And despite the fumble with the bundles, they aren't sitting still on the product development front. Some of these new features are actually fascinating.
Yeah, the clear standout for me is a new feature called Carfax Homegrown.
Oh, this one is so smart.
Right. It's a tool designed to identify used cars sitting on a dealer's lot that were originally sold brand new by that exact same dealership and then serviced exclusively in that dealership's service bays for its entire life.
It is a brilliant use of a data moat. Consumers inherently place a higher value on those specific vehicles. I mean, if a car has a consistent, documented service history at the original dealer, it just signals reliable professional care. It removes all the mystery of the used car lot.
Exactly. By leveraging their massive database to automatically surface those specific vehicles, Carfax is giving dealers a tangible way to market those cars at a premium price. It directly helps the dealer's bottom line.
And they're also pushing forward with other targeted tools, right? Like Carfax Showroom and introducing new Automotive Mastermind SMS offers to integrate texting directly into the dealer workflows.
Yeah.
Plus, they're officially launching Carfax in Germany.
Yeah, they're trying to replicate that North American dominance in a massive European market. And all of this product innovation is happening simultaneously with a massive internal restructuring. They're calling it their One Mobility Global strategy.
Because they just completed the spinoff from S&P Global on July 1st.
Right, so they're currently in the messy process of integrating 5 previously separated businesses into one cohesive platform. platform. The goal is to seamlessly share data across all these new products, breaking down the internal silos.
Which is critical because that's where the long-term margin expansion is supposed to come from. If they can share data seamlessly on the back end, the cost of developing new products drops significantly. But your earlier point about dealership budgets being squeezed ties directly into the broader macroeconomic risks that management is staring down right now.
Yeah, because you can build the most innovative products in the world, but if the end market is shrinking, your revenue is going to stall out.
So let's pivot to that macro environment. Management really didn't sugarcoat the reality they're facing, especially outside the U.S.
No, they didn't. During the earnings call, they explicitly noted they are seeing softer automotive activity internationally. That slowdown is specifically weighing on their B2B segment and their Carfax Canada operations. And this ties right back into that transactional revenue piece we discussed earlier.
Because transactional revenue is entirely volume linked. They get paid a fee every single time a dealer or a consumer pulls a specific vehicle history report. So if overall auto sales volumes dip, fewer people pull reports, and that revenue stream takes an immediate hit.
Right, and with transaction volumes dipping outside the U.S., that segment's growth was held to just 5%. But more importantly, for anyone looking at the forward guidance, management stated they are assuming absolutely no meaningful macroeconomic improvement in the second half of 2026.
Wow, none at all.
None. They are not modeling a recovery. They are actively bracing for this sluggish environment to persist.
Which brings us to the elephant in the room, their newly independent balance sheet. This is where the actual mechanics of a corporate spinoff really matter for retail investors. Because if you're looking at investing in this stock, you have to understand the debt structure they just inherited.
Yeah, the balance sheet is carrying a very heavy debt load, and it's a direct engineered result of the separation from S&P Global. Mobility Global is currently sitting on roughly $1.98 billion in long-term debt.
Nearly $2 billion.
Yep. To put that leverage into context, that is 2.4 times their trailing 12-month adjusted EBITDA.
And it is so critical for you to understand exactly where that $2 billion in debt came from.
Yeah.
Because it wasn't used for growth. They didn't borrow $2 billion to go build state-of-the-art data centers or acquire a competitor.
No, the debt was generated primarily by issuing senior notes for one specific purpose: to fund a massive $2.0 billion dividend that was paid straight back to their former parent company, S&P Global, right before the separation was finalized.
It is the ultimate corporate equivalent of moving out of your parents' house.
Right.
You finally get your independence, you have your own place, but right before you walk out the front door, your parents force you to take out a massive $2 billion bank loan just to pay them back for the cost of raising you.
It is a brutal way to start your independent life. I mean, you're out in the world trying to furnish your new apartment and build your career, but you have this massive monthly interest payment hanging over your head from day one.
Right.
And on top of that structural debt burden, the company is facing about $100 million in one-time separation costs, with roughly $50 million of that expected to hit the income statement in 2026 alone.
And those interest payments alone are staggering. They expect about $55 million in interest expense just in the second half of this year. But here is the interesting dynamic. Despite that heavy leverage, the board of directors is projecting immense confidence in the company's free cash flow generation.
They really are. They launched on July 1st with $186 million in cash on the balance sheet, and they immediately initiated a quarterly cash dividend of 6 cents per share.
Wow, right out of the gate.
Right out of the gate.
Yeah.
That dividend is payable on September 10th to shareholders of record as of August 27th. It's a clear signal to the market that they believe the core business generates more than enough cash to service the spin-off debt and still return capital to shareholders.
Though they did draw a line in the sand regarding share buybacks. Management made it very clear that share repurchases are completely paused until early 2027. They need to digest this initial debt load and get through the friction of the separation costs before they start buying back their own stock. So looking at the entire picture, the bundled sales fumble, the heavy debt, but also the massive margins and the new product pipeline, where does this leave the valuation?
Well, the stock is currently trading at a price-to-earnings ratio of roughly 29. That is undeniably a premium multiple, especially for a company that just cut its top-line growth guidance down to the 7% range. However, analyst sentiment remains mixed, but generally leans positive.
Why is that?
The bullish argument is that Mobility Global actually trades at a discount when you compare it to similar high-margin data monopoly providers in other sectors.
And the analyst price targets really reflect that divide and how the market is digesting the spinoff, don't they? I know Baird initiated coverage at neutral with a $23 price target, citing the volatile short-term trading dynamics that usually follow a corporate separation.
Right, but then you have Wolf Research initiating at outperform with a $25 target, and Wells Fargo initiating at overweight with a $27 target. And if you look at the broader consensus, some targets stretch all the way up to $37 a share.
It really all comes down to whether you believe their subscription base is durable enough to weather the macroeconomic headwinds while they steadily pay down that massive S&P global debt. Because, the introduction of data features like Carfax Homegrown proves that consistent long-term care fundamentally increases a vehicle's value in the open marketplace.
Absolutely.
But looking at the recent stumble with the Carfax bundled sales strategy, you have to wonder, do they need to apply that exact same philosophy of consistent care to their own dealership relationships? Will their newfound corporate independence make them agile enough to adapt to tight dealership budgets? Or will this heavy debt load and the total lack of a parent company safety net leave them dangerously exposed to shifting global winds?
That's the billion-dollar question. And if you want to follow how management navigates this debt load and whether this go-to-market reset actually revives top-line growth next quarter, be sure to follow the show for daily earnings coverage.